Joining us now in a Fox Business exclusive is Ambassador Terry Miller, Heritage Foundation's International Trade and Economic Center Director. Ambassador, thank you for being here. Why would the Chinese sale of U.S. treasuries cause any kind of earthquakes in the markets?
Well, because it would affect interest rates. A big sale by China of U.S. treasuries would cause interest rates in the U.S. to rise and, in fact, around the world. And that tends to slow down economic activity and could even plunge us into a recession. But I do think it's important to keep this in context. China owns about 5% of the U.S. treasuries that are owned by everyone in the world, including Americans. Japan, for example, holds a similar amount to China. So there are people who could have an impact on the market. But as we've seen this week in the stock market, a very small movement in Chinese currency rates caused a huge drop in the U.S. stock market, but then over a couple of days we recovered all of that.
Indeed,
so
yeah.
I don't think we would need to worry about anything other than some initial panic. The markets would be able to adjust to this pretty rapidly, and the U.S. can respond also. The U.S. has the ability through the Federal Reserve to buy and sell these bonds in the market. So we have the ability to counter any particular Chinese moves in this regard.
And on top of that, these weapons that they could turn from bonds to machetes or whatever it is, they could be boomerang effect type of situations where they could also hurt China in doing so. Look at what happened with the yuan. The yuan hit a what was it, an 11-year low, actually. In fact, it's still at 11-year lows, even though it is back above the psychologically very important level of 7 yuan to the dollar. So it fell below to like 6.99 the other day, and the markets had a complete freak out. But that can, in turn, really hurt China because they'll see capital flight at some point where people say that these yuan are worth nothing. We got to get them out.
That's absolutely right. Same thing with the bond market. This is going to slow down growth in China if they were to take this action, and they can't afford that at this point. President Xi Jinping needs to keep the Chinese growth rate up. It's at least 6 or 7% to satisfy their growing population and to provide jobs for all of the people that are moving to the cities in China. He can't afford to see growth just tank in China. And anything that would attack the international bond market, particularly the U.S. Treasury aspect of that, would cause a kind of disruptive instability. Sure, that could hurt the U.S. a bit until we reacted, but it's going to hurt China, too.
We also noticed that China's stockpiling, or at least it appears it's stockpiling gold. It is in its 8th month of purchasing a lot of gold. I think in the month of July, China purchased something like 10 tons of gold. So they're on this buying streak, and it's almost like they're preparing for Armageddon or something like that. I mean, do you look at that anyway? And by the way, gold is still above $1,500 an ounce, and that is a 6-year high.
Well, there's not enough gold in the world for China to shift entirely into that, to hold all of its reserves, all of its dollar reserves. But I think what we're seeing here is as U.S. trade with China gradually declines, there's less need for China to be holding substantial U.S. dollar-denominated assets. You would expect over time that China would reduce its holding of U.S. treasuries in a gradual way, in a way that doesn't disrupt the market. That's just a natural effect of these declining trade flows that we're seeing right now between the U.S. and China.
We should just mention that we are at session highs for the stock market, so it doesn't appear that the stock market's nervous, and you don't sound too concerned, Ambassador. Thanks for joining us.
My pleasure, Liz.
Anytime. Ambassador Terry Miller. We're coming right back.